Welcome back to Faceless Business School, where we break down complex accounting standards into simple, easy to understand concepts. Today we are discussing IAS 1, Presentation of Financial Statements. Let's get started. Our lesson will cover an overview of IAS 1, the objective of IAS 1, the main components of financial statements, and key principles and assumptions used in the preparation of financial statements. Overview of IAS 1. IAS 1 Presentation of Financial Statements sets out the overall requirements for financial statements, including how they should be structured, the minimum requirements for their content, and overriding concepts such as going concern, the accrual basis of accounting, and the current or non-current distinction. IAS 1 was reissued in September 2007 and applies to annual periods beginning on or after January 1st, 2009. A key thing to note here is that IAS 1 will be superseded by IFRS 18, Presentation and Disclosure in Financial Statements, which becomes effective for annual periods beginning on or after January 1st, 2027. Objective and scope of IAS 1. The objective of IAS 1 is to prescribe the basis for presentation of general purpose financial statements to ensure comparability with both the entity's financial statements of previous periods and with the financial statements of other entities. The overall requirements for the presentation of financial statements, guidelines for their structure, and minimum requirements for their content are set out in IAS 1. Scope of IAS 1. IAS 1 applies to all general purpose financial statements that are prepared and presented in accordance with IFRS. The objective of general purpose financial statements is to provide information about the financial position, financial performance, and cash flows of an entity that is useful to a wide range of users in making economic decisions. To meet that objective, financial statements provide information about an entity's assets, liabilities, equity, income and expenses, contributions by and distributions to owners, and cash flows. That information, along with other information in the notes, assists users of financial statements in predicting the entity's future cash flows and, in particular, their timing and certainty. Components of financial statements. A complete set of financial statements include a statement of financial position or the balance sheet, a statement of profit or loss and other comprehensive income, a statement of cash flows, statement of changes in equity, and notes to the financial statements. We'll take our time and discuss each of these statements in detail. We begin with the statement of financial position or the balance sheet. Think of the balance sheet like a snapshot of what the entity owns and owes. This statement shows the assets, liabilities, and equity balances of the business at the end of the reporting period. Classification or grouping of assets, liabilities, and equity in a consistent manner helps users of financial statements to understand that information and it more easily identify information which is of relevance to them. Consistent presentation of information also helps users to make comparison and undertake analysis of financial information. An entity must normally present a classified statement of financial position, separating current and non-current assets and current and non-current liabilities. Let's discuss what these items mean. We begin with current assets. Current assets are assets that are expected to be realized in the entity's normal operating cycle. They are held primarily for the purpose of trading and they are expected to be realized within 12 months after the reporting period. Examples of these include cash and cash equivalents, inventory, and accounts receivables. All other assets that do not meet this definition are considered non-current assets. Current liabilities. Current liabilities are those expected to be settled within the entity's normal operating cycle. They are held for trading. They are due to be settled within 12 months, for which the entity does not have the right at the end of the reporting period to defer settlement beyond 12 months. All other liabilities are considered non-current liabilities. The relationship between the assets, liabilities, and equity can be represented with this equation, where assets equals the liabilities plus the equity of the entity. Statement of profit or loss or other comprehensive income. This statement summarizes the revenues and expenses incurred by the business throughout the reporting period. Mathematically, it is expressed as revenue minus expenses, which will give us either a profit or a loss. Profit or loss is defined as the total of income less expenses, excluding the components of other comprehensive income. Other comprehensive income is defined as comprising items of income and expenses, including reclassification of adjustments that are not recognized in profit or loss as required or permitted by other IFRSs. The total comprehensive income is defined as the change in equity during a period resulting from transactions and other events other than those changes resulting from transactions with owners in their capacity as owners. Expenses recognized in profit or loss should be analyzed either by their nature, for example, raw materials, staffing costs, depreciation, or by function, cost of sales or selling expense or administrative expense, etc. Choice in presentation and basic requirements. An entity has a choice of presenting a single statement of profit or loss and other comprehensive income, or two statements, statement of profit or loss and a statement of comprehensive income, immediately following the statement of profit or loss and beginning with profit or loss. The third component of financial statements, statement of changes in equity. IAS 1 requires an entity to present a separate statement of changes in equity. This statement summarizes the movement in equity balances, which can be share capital, share premium, revaluation, surplus, and retained earnings, from the beginning to the end of the reporting period. It usually applies only to limited liability companies and would not be required for a sole trader or partnership. Statement of cash flows. The statement of cash flows is the subject of IAS 7, statement of cash flows, which we will look at in a separate lesson. Statement summarizes the cash paid and received throughout the reporting period. Normally, it would be relevant to limited liability companies only rather than to sole traders and partnerships. In the preparation of the statement of cash flows, the statement outlines cash inflows and outflows from operating, investing, and financing activities. Finally, the notes to the financial statements provide additional information that helps users understand the numbers in the financial statements. This can include accounting policies, explanations of significant items, and other disclosures. The notes must present information about the basis of preparation of the financial statements and the specific accounting policies used. The notes must also disclose any information required by IFRSs that is not presented elsewhere. The notes must also provide additional information that is not presented elsewhere in the financial statements, but it is relevant to an understanding of any of them. The notes are presented in a systematic manner and cross-referenced from the face of the financial statements to the relevant note. Key principles and assumptions. We will discuss a number of key principles and assumptions that are used in the preparation of financial statements. We begin with the going concern assumption. The conceptual framework notes that financial statements are normally prepared assuming the entity is a going concern and will continue in operation for the foreseeable future. IAS 1 requires management to assess an entity's ability to continue as a going concern. If management has significant concerns about the entity's ability to continue as a going concern, the uncertainties must be disclosed. If management concludes that the entity is not a going concern, the financial statements should be prepared on a going concern basis, in which case IAS 1 requires a series of disclosures. The accrual basis. IAS 1 requires that an entity prepares its financial statements except for cash flow information using the accrual basis of accounting. And this means recording transactions when they occur and not when cash is exchanged. Consistency of presentation. The presentation and classification of items in the financial statements must be retained from one period to the next unless a change is justified either by a change in circumstances or a requirement of a new IFRS. Materiality and aggregation. Information is material if omitting, misstating, or obscuring it could reasonably be expected to influence decisions that the primary users of general purpose financial statements make on the basis of those financial statements. Each material class of similar items must be presented separately in the financial statements. Dissimilar items must be aggregated only if they are individually immaterial. However, information should not be obscured by aggregating or by providing immaterial information. Materiality considerations apply to all parts of the financial statements, and even when a standard requires a specific disclosure, materiality considerations do apply. Offsetting. Assets and liabilities and income and expenses may not be offset unless required or permitted by an IFRS. Summary of key takeaways from this lesson. The objective of IAS 1 ensures financial statements provide useful information for decision making. The components of financial statements include the balance sheet, income statement, statement of changes in equity, cash flow statement, and the notes to the accounts. We also discussed key principles and assumptions that are used in the preparation of financial statements, and these included going concern, accrual basis, consistency, materiality and aggregation, and offsetting. IAS 1 helps in presenting financial information clearly and consistently, ensuring transparency and comparability across companies. If you found this video helpful, don't forget to like, share, and subscribe for more accounting lessons. And if you have any questions or topics you would like us to cover, drop a comment below. Thanks for watching and see you in our next lesson.